Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Ryan Grabinski. He is managing director and investment strategist at Strategas, and we're going to talk all things markets as we start the year hot. Ryan, how are you doing today?
I'm doing well, Ross, and always good to be back.
Great to have you on. Our conversations are always insightful because I think it's good for investors to kind of get a 30,000 foot view of things. And with that in mind, I want to talk about the market gauge, which is the exercise that you all go through, every now and again to kind of take stock of the markets and the economy at a point in time. And you downgraded fiscal health, and I wanted to talk about why that was and what your outlook for that sector was going forward.
Yeah, absolutely. So our market gauge declined again in the latest iteration. It stands at -8 now. Really, the downgrade for fiscal health was really a function of rising interest rates. So as you know, the U.S. debt is roughly 50% due. 50% of it comes due in the next 3 years. And so obviously, there's an expectation that that debt will get rolled, but as it gets rolled, it's going to get rolled at a higher rate. That the 2-year yield is yielding about anywhere between 4.25% and 4.5%, depending on the day. And obviously, the interest cost, the average coupon right now stands at 1.8%. So basically under the expectation that debt's going to have to get rolled, and we have higher interest rates than when that debt was issued 2 years ago. So that's our view, that we'll ultimately have to increase the interest cost because we're rolling at higher rates.
Right, and certainly everybody at this point is aware that there's a big debt ceiling fight that's looming over the market this year that will probably ramp up, and that's a big piece of things as those costs get more expensive. Spending elsewhere comes into focus. So, higher level, thinking about the gauge as it stands today, is there anything on your radar that could be, upgraded or downgraded in the coming months that investors should be on the lookout for?
Yeah, I mean, it feels like we're a broken record when we start talking about profits and margins here, but obviously, we're watching profits pretty closely. The 2023 earnings estimates have continued to come down. They're right now, they stand at about $224 a share. That's down from about $250 a share in the middle of 2022. So that's a pretty significant revision lower. The market still expects a growth rate of about 2%. Obviously our consensus, that's the consensus. Our view is that earnings could actually decline this year. And so far we've at least had the direction right. I think from a margin standpoint, if you look at operating margins have peaked out at about 17.7%. And they've come into about 16.2, so that's a 150 basis point decline already in operating margins. So that's the profits and margins is certainly an item that we'd be looking to watch and could potentially be downgraded in the future. I think on the flip side of that, you have to in terms of items that could potentially be upgraded. Commodities certainly is one that I would be keeping an eye on here. The oil prices have basically stabilized at the in the $70 to $80 range. You look at something like natural gas prices, which is an input cost to a lot of manufacturing and utility bills. Obviously, it's been warmer, so natural gas prices have fallen. That the combination of those two actually helps the consumer out here. So that's one item. Economic growth, even obviously it's been able to hang in for quite some time. If you look at the Atlanta GDP tracker, it had been 0.7, expecting 0.7 for this quarter, and it's actually ticked up to around 2% now. So that's another item that is worth keeping an eye on. I don't know that those would be immediate upgrades, but certainly something to keep an eye on here as long as the labor market remains strong.
Yeah, and I think that combination of things, growth hanging in there, commodities percolating, but earnings coming down, just speaks to the kind of complicated economic moment we're in. And all of that is the backdrop for what has been a really tremendously strong rally to start the year. Paused a bit over the last few days, but kind of a historically strong January. So I'm wondering, with all of that backdrop, how do you all take stock of the current market rally, and what would you think, how investors should be positioning going forward?
Yeah, we've been pretty cautious, I would say. We were cautious throughout last year, and we've remained cautious during the first 6 weeks of this year. Obviously, that has worked against us. We've had this cyclical sector rally, but we remain overweight the staples, healthcare sectors, which tend to be more defensive. Even from an asset allocation standpoint, we're underweight equities. And have higher than normal levels of cash. I think generally speaking, investors are trying to look through the recession that hasn't occurred yet. I will say that the strength in the labor market is kind of the one thing that perplexes us, and could ultimately make our call look wrong here. If the labor market remains persistently strong, and even this morning we got another initial claims number that was under 200,000, so it's still strong. But as long as it remains strong, it's going to be difficult to kind of get that sort of negative outlook that we've been calling for. But investors are looking through the idea that there's going to be a recession before the recession actually occurs. The Fed has obviously tightened a significant amount over the last 12 months, and historically that tightening acts with a lag. So we still think those effects from the tightening are yet to be felt, and which is really the reason why we maintain a more defensive posture in terms of our portfolio positioning. If we do see something change, obviously we'll have to change our stance. But for now, we're kind of sticking with it, even though it's getting more difficult to kind of hang in the pocket there.
Sure. Well, and we always appreciate that. As the facts change, people need to change their minds. So luckily we'll have the opportunity to talk to you again down the road, and we'll get the updated outlook. But for now, Ryan, I want to thank you so much for the time, and again, hopefully talk soon.
Absolutely, Ross. It was great chatting.